Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance. Today, we're diving deep into VEEA Incorporated's latest proxy statement, and let me tell you, it is a real page turner with a few key moves that could shake things up for shareholders. So, buckle up, because we're about to unpack what is really going on, and hey, if you love getting these straight to the point analyses of important corporate documents, do us a favor and hit that subscribe button. Also, we have a fantastic community over on Discord, linked in the description below, where we discuss these filings and much more. Alright, so what is the main event here? VEEA is calling its annual meeting on the 30th of December 2025, and they've got a packed agenda. Think of it like a shareholders report card, mixed with some important decisions that could change the company's structure. First up, they're looking to elect 2 new directors. This is standard procedure, but it's always a good idea to see who they're bringing on board, and if they bring new expertise to the table. The company highlights that these directors are chosen for their industry experience and diverse backgrounds, which is always a positive sign. Now, things get interesting with proposal number 2. They want shareholder approval for a reverse stock split. This is a move many companies make, especially if their stock price has fallen below certain thresholds, like the $1 mark that Nasdaq requires for continued listing. It's basically a way to consolidate shares, aiming to boost the PER share price without changing the company's overall value, at least not immediately. VEEA mentions they received a notice from Nasdaq about not meeting the minimum bid price requirement, and they have until the 30th of March 2026 to fix it. This reverse split is their primary tool to try and stay listed on Nasdaq. However, it is crucial to remember that a reverse split doesn't magically add value. The company itself warns that they cannot guarantee the stock price will stay up or that this move will prevent delisting in the long run. It is a strategic move to meet listing rules, but it doesn't solve underlying business issues. Proposal 3 concerns their 2024 equity incentive plan. They're asking to increase the number of shares available for employee stock awards. They want to add over 9.5 million shares to the plan, plus an annual increase for several years. The company argues this is essential for attracting and retaining talent, and to link executive pay to long-term stockholder value. They highlight they've already granted some awards, and without this increase, they'll have trouble keeping promising employees and directors. They even show specific dollar values for stock awards to executives like Mark Tubinis, Michael Somasi, and Helder Antunes, indicating these grants are a significant part of their compensation strategy. Proposal 4 is pretty straightforward. It is about ratifying the appointment of their auditor, PKF O'Connor Davies, LLP. This is a standard part of corporate governance, ensuring that an independent firm is reviewing their financial statements. The report indicates that PKF has been their auditor since August 2023. The fees paid to PKF are broken down, showing audit and tax services. For 2024, they paid PKF $641,771, and for 2023, it was $438,975. This shows a significant increase in audit fees year over year, which might reflect the increased work or complexity of their financial reporting. Then we move to Proposal 5, the Say on Pay vote. This is where shareholders get to cast an advisory vote on the compensation packages for VEEA's top executives. The company explains their compensation philosophy, which includes base salary, annual bonuses, and equity awards aiming to align executive interests with stockholder value. They emphasize that equity compensation is key for attracting and retaining talent and for linking pay to performance. They also mention a clawback policy, which means executive bonuses could be reclaimed if there is fraud or misconduct leading to a financial restatement. Proposal 6 relates to the frequency of these say-on-pay votes. Shareholders are asked to decide whether they prefer this advisory vote to happen every year, every 2 years, or every 3 years. VEEA's board is recommending a 3-year cycle. Their reasoning is that their equity compensation is designed for long-term value, and a 3-year vote would better align with judging performance over that time frame. They also believe it gives the board enough time to consider and respond to shareholder feedback. Finally, Proposal 7 is for any other business that may properly come up during the meeting. This is a catch, all to ensure the meeting can cover anything unexpected. Looking at the ownership, it is clear that Alan Salmasi, the CEO and chairman, holds a significant chunk of the company, with about 47.4% of the shares. Then there is NLabs Inc., another entity controlled by Mr. Salmasi and his family, holding a hefty 38.7%. It means a few key players have a lot of sway. In terms of lease arrangements, it is interesting to see that VEEA has extended its office space lease with 83rd Street LLC until the 31st of December 2025. The unique part here is that the sole member of 83rd Street LLC is the Salmasi 2004 Trust, and the rent for this office space is accrued and not paid in cash. where the CEO's family trust effectively supplies office space without immediate cash payment. Definitely stands out. Let's dive into some numbers. In the executive and director compensation section, we see for the fiscal year ending the 31st of December 2024, Douglas Main, Kanishka Roy, Alan Black, Helder Antunes, and Gary Cohen each received $20,000 in cash fees. On top of that, they were each granted stock awards valued at $250,000. For example, Douglas Main received a total compensation of $270,000 in 2024. These equity grants are a pretty substantial part of their total compensation, showing the company's reliance on stock-based incentives to reward its directors. When we look at the auditor's fees for the year ending the 31st of December 2024, the company paid $620,472 for audit fees and related services, and $21,299 for tax fees, bringing the total to $641,771. This is a noticeable increase from 2023, where the total was $438,975. This jump in fees might indicate more complex audits or additional services rendered by PKF O'Connor Davies LLP. Now, let's break down what this all means for VEEA Incorporated. The company is clearly focused on survival and meeting Nasdaq's listing requirements. The reverse stock split proposal, while standard, highlights the pressure they're under to boost their stock price. The biggest risk here is that if the split doesn't work as planned, they could still face delisting, which would severely impact their ability to raise capital and trade their shares. The heavy reliance on equity compensation for executives and directors, as seen in the stock awards and the proposed increase in the share pool for their incentive plan, shows a strategy to align interests with long-term growth. However, it also means that a significant portion of their compensation is tied to the future performance of the stock, which is currently trading at low levels. The substantial ownership by the CEO and entities he controls, along with the related party lease and loan arrangements, suggests a tightly held company where decisions are concentrated. While this can sometimes lead to quick execution, it also means less diversification of viewpoints. The increase in auditor fees is something to keep an eye on, while not necessarily a red flag. It often suggests more scrutiny or complexity in the financials. Overall, VEEA is at a critical juncture. They are taking steps to remain listed on a major exchange and to incentivize their team for future growth. However, the success of these strategies hinges on their ability to increase their stock price and demonstrate significant improvement in their business operations. The company's direction seems to be leaning heavily on future potential, fueled by equity incentives, but the immediate challenge of maintaining their Nasdaq listing is a significant hurdle. What is your take on VEEA's plans? Do you think the reverse stock split will be enough to keep them on Nasdaq? Let us know your thoughts in the comments below. If you found this deep dive helpful, please give it a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community for more discussions like this. Thanks for watching, and well, see you in the next video.